Hello everyone. In my financial economics series, I want to introduce this paper with my first video on this topic, the difference between investors and traders. What are the basic difference which make the investors different from traders? And I will also discuss the classification of investors and the type of traders present in the market. So let's find out. Before discussing the kinds of traders and the trading style, we should first know the classification of trades. As we know that trading is done for a short-term profit. It has a short-term time horizon. So on the basis of time frame or holding period in which trading instruments are bought and sold, trades are classified into four types. Number one is hourly income trade, where the positions are held for seconds, minutes, or for few hours. Second is daily income trade, where we hold positions throughout the day. Third is weekly income trade, where positions are held for days or weeks. And the fourth is monthly income trade, where the trading positions are held for months. Weekly income trade is also called as a swing trade, and monthly income trade is called the positional trade. On the basis of trading style, traders are classified into four categories. On the basis of holding period in which trading instruments are bought and sold. Number one is scalp trader or scalper or an hourly income trader. Number two is day trader. Number three is swing trader, and number four is positional trader. If we talk about the scalper or hourly income trader, they involved in hourly income trade. That means the position are held for seconds to minutes and they do not have overnight position. If we talk about the day trader, they involved in daily income trade and the positions are held throughout the day only. There is no overnight position for day traders. Now, the third is the swing trader. They are also called as a weekly income trader and they involved in weekly income trade. They hold the position from days to week. And the fourth is the positional trader. They are also called as the monthly income trader. They involved in monthly income trade where they hold the position from months to years. Now, the important question that comes here is, what are the factors which influence the trading style of the traders? So the trading style of a trader depends upon following factors. Number one, the level of trading experience of the trader. Number two is the personality of the trader. Number three is the account size of the trader. Number four is the time, the amount of time that trader can dedicate to trading. And number fifth is the risk tolerance capacity of a trader. So all these 5 points play a very important role in deciding the trading style of the trader. We have seen the kind of traders on the basis of trading style. And we have also discussed that traders involves in more frequent transaction of buying and selling of securities in the market for the short term. They believe in short-term strategies to maximize returns on trade taken on hourly, daily, monthly, or quarterly basis. Traders do not care for long-term value of an asset like investors. They concentrate on short-term strategies to earn profit. Therefore, traders trade in the derivative market like futures and options. What is the specialty of derivative market? Derivative market is the market where all the contracts have a life cycle, that is, the time of expiry, the contract cycle, which has to be followed by the traders. So, on that ground, traders are classified as hedger, speculator, and arbitrator who takes trade for the short term and try to maximize the profit. If we talk about the hedger, we will see that hedgers are a kind of traders who use derivatives to reduce the risk that they face from the potential future movement in the market variable. In a simple word, we can say that hedgers are risk averse. Why? Because they wish to protect themselves from risk and uncertainty involved in price movement. Now come to speculators. Speculators are the kind of traders who use derivatives to bet on the future direction of the market variable. Speculators are considered as risk lovers. Why? Because they are extremely high risk seekers who anticipate future price movement in hope of making large and quick gains. While arbitrator is the kind of trader who takes offsetting position in two or more instruments to lock in a profit. Or in simple word, we can say that arbitrator is a low risk trader who involves buying of securities in one market and simultaneously selling it into the another market. This can happen when the same securities are trading at different prices in different markets. After seeing the classification of traders, now we will see the classification of investors who acquire assets with the expectation of profit over the long run. Investors are basically classified into three types: risk lover, risk diversifier, and risk averse. This classification of investor into three types is based on the risk appetite of the investor. We have seen that investors are more likely to ride out short-term losses or fluctuation, while traders attempt to make transactions that can help them to profit quickly from the market fluctuation. So, investors prefer to invest for a long run. Now, if we talk about the risk lover investor, we find that risk lover are a kind of investors who believes in high risk, high return. They have huge risk appetite and they play with the market volatility. Risk lover investors generally invest in the market-linked instruments like equities, mutual funds, which are highly risky and have the probability of high return. Whereas on the other hand, there are a kind of investor called risk averse. Risk averse investor believes in low risk, low return. They are the investor with a low risk appetite. They generally go for the investment which has calculated returns like fixed income security. They invest in government bonds, etc., which provide them a short return. The third kind of investor are risk diversifier. These are the investors who believes in portfolio diversification. They make this strategy for risk management. Risk diversifier basically aims at portfolio diversification, and the strategy used by them is to manage the risk by spreading their money across different assets and sectors, considering that if one sector experiences turbulence, other should balance it out. So basically, the risk diversifier believes in not putting all the eggs in the same basket. That is portfolio diversification. Therefore, they try to make a portfolio by investing in both risky and a risk-free asset. And that diversification also depends upon the risk appetite of the risk diversifier. So in this way, we can see that investors are of three types: risk lover, risk averse, and risk diversifier. If you have any question on this presentation, please put your question in the comment section and like and subscribe my channel to get further notification. Thank you so much.